Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonell and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.
Hey guys, this is Justin. In this episode, Jack and I have back one of our favorite guests, Cullen Roche, founder and CIO of Discipline Funds, to talk inflation. From how to measure it to how we got here, to what it means for the markets and the economy, fiscal and monetary stimulus, to where inflation may be headed in the future. With the market expecting rate cuts this year and next, the level of inflation will be something investors will be paying close attention to. Cullen brings a disciplined, pragmatic approach to how he views inflation in the economy. As always, thank you for listening. Please enjoy this discussion with Discipline Funds' Cullen Roche. Cullen, always a pleasure to have you back on Excess Returns. How are you?
I'm great. How are you guys?
We're good. We're good. We always like to bring you on once or twice a year, circle the wagons, kind of talk about the economy, sort of big ticket items that are sort of just in the economy and important to the economy, and trying to take a, data-driven, pragmatic approach to how we look at this stuff, which is what you do and what we really value about having you on. So always appreciate the time.
Thanks. Yeah. I mean, I think everyone kind of knows, especially over the course of the last 10 years, macro is just so up in front in our faces all the time that it's something that even if you're not applying it in like a really, daily useful way, it's still something that in a general sense, I think is important to understand just to help you navigate a lot of the understandings of what's going on.
Yeah. And I don't know if that's like post-great financial crisis thing with the Federal Reserve and just how much the Fed and the government after COVID was sort of involved in the economy, or that's maybe just recency bias for me. But I think
that's right. I think that's a big part of it is that with the GFC and then COVID, I mean, you have these environments where the government and the Fed is so hyper involved in a specific instance that if you don't understand that or you misunderstand it worse, you can get caught flat-footed or get caught in sort of like, I think, misleading concepts that can convince you to do something really stupid, which is, I mean, good investing to a large degree is about avoiding huge, disastrous mistakes. And so if you're someone who, following the GFC, thought that, QE was going to cause hyperinflation and you sold all your stocks and bonds and you moved all into, whatever, some sort of inflation hedge or whatever it was, that ended up being a pretty disastrous mistake for a pretty long time. So it depends. It's all sort of environment specific, but understanding this stuff has become more important because the Fed and the government has just become so much more involved in the way that we all operate every day.
It's really cool that you were like, the first person on that, like on that QE thing. You were one of the people out front. Like I was listening to a podcast the other day with like a big time macro guy, and he was talking about that and he's like, yeah, and I understood because of Cullen Roche that, QE was not going to be inflationary. So it's kind of cool that you were like one of the people that figured this out.
I got super lucky. I had not only studied Japan, but I knew a bunch of guys who were in Japan who were asset managers. This was before the financial crisis, really. And so and then when the Fed started implementing a lot of the policies that Japan had been doing for 20 years, it was weird. It was almost like having a cheat book. Like I had been to the future and I knew what this thing was going to do because the Japanese were sitting here telling me, Cullen, we know what this does. We've been doing this for 20 years. And weirdly, a lot of Americans just ignored it, even though there was like hard empirical evidence about what QE did in Japan. So it's not, part of it is, or a big part of it is just that I was lucky and not necessarily smart.
We wanted to spend, I think, a lot of the time today just kind of talking about inflation, where we're at, ways to measure inflation and the different things we're seeing around sort of inflation as, I guess, a topic. I think it was probably more top of mind when inflation was running much hotter. But I also think that, given what transpired in the market at the end of the last year with the kind of the rip your face off rally and the expectation of lowering rates from the Federal Reserve, that obviously all plays into the inflation narrative. And I think, how investors are trying to think about things and position their portfolio for growth and for wealth creation. So anyways, let's start with, there's a lot of different ways that inflation can be measured, and you see a lot of different indicators and indices, I guess, inflation, different indexes in the market. So can you just kind of walk us through how you actually think about what inflation actually is, and if any one of those really sticks out to you as the main one that you really pay attention to?
Yeah. So I think the most important one is the core PCE, which is the core personal consumer expenditures inflation index. And that's the most important one because that's the one the Fed cares the most about. So that's the one that I think most impacts policy, which is the thing that ultimately impacts portfolios and interest rates and everything, on the ground. And so core PCE is kind of the go-to, but there's lots of different ways to skin the inflation metric cat. So there's headline PCE, there is headline CPI, there's core CPI. In the last few years, the Fed has created, or the analysts have created narratives around like super core, which is like not just taking out food and energy, but taking out food, energy, shelter, and autos, and like all these other things that people were saying were causing sort of discrepancies in the data. And I think it's useful to look at all of these things. I mean, core PCE is obviously the most important one, but to gauge where inflation may be going or just what really is happening, I think it's useful to look outside of even the government data. So like me personally, I'm a big advocate of looking at just commodity prices. So I think if people want like the truest, best real-time indicator of what's going on with inflation, and you want something that is not really manipulated, that is more sort of market-based, you just go straight to like the Bloomberg Commodity Index and look at like the year-over-year rate of change. And you can kind of get some confirmation on what's going on. Does this actually jibe with like what's going on with CPI or PCE, or is the government just, full of it? And because that's the other thing, like the way that inflation is measured is incredibly complex, and it's not going to be reflective of any individual person's actual inflation experience. So the Bureau of Labor Statistics is doing sort of an impossible job to begin with, and it's filled with sort of guesswork, and then you've got things like lagging data. And so and that's another thing, is that all of this is really environment specific. So one type of index might be more relevant in a certain environment than others. So for instance, today I would argue that something like the CPI X shelter actually is a really useful index to look at, because you can look at inflation as a whole. And we also know that the way that the Bureau of Labor Statistics measures inflation, and shelter in particular, has sort of a flaw in it that tries to mimic the way that renters actually experience inflation. Because like when inflation goes up, all renters don't experience an automatic increase in their rents, for instance. It lags. Some renters might not even experience it on a year-over-year basis. Some rental contracts might not move up, more than once every 2 years or something like that. So the BLS, they measure this on a 6-month basis, and that has this big lagging impact where you won't actually see this bleed into the data for, say, 9 to 12 months maybe. And so you can get indicators where real-time rents are falling like they are right now, and you can still have in the BLS data and in the CPI data, shelter inflation showing up at like 6%. So it's showing up at 6% year over year right now. And we know for a fact that rents are actually flat to down year over year. So when you look at something like that in this specific environment, I think that gives you a truer sort of understanding of where inflation is at. And when you X shelter, you get to like a 1.8% year over year inflation rate, which actually seems a lot more consistent with, I think, where the economy is at and where inflation is probably going to be in about 6 months when you actually see this sort of bleed into the data. So to answer the question succinctly, I like looking at lots of indicators, especially things outside of the government, even some of the newer ones like, Trueflation is an inflation indicator that is really popular on Twitter, that, they're providing more of a private sector view of inflation that gives you a really broad idea of what the consumer price basket looks like. And it's an independent read that you can compare and contrast then to the government data, and you can kind of get a better understanding of, okay, how bad is the government data relative to my actual inflation experience? And can I compare and contrast this to other indicators? And are those other indicators consistent with something that feels more accurate?
Remind me again, you're out in California, right? This is going somewhere, by the way.
Yep.
Okay. So I think, yeah, I'm pretty sure. So California just passed legislation where, at least in the fast food space, but minimum wage is going from $16 to $20 an hour. And I'm just wondering, like, what do you think? I mean, do you think as wages continue to go higher, and that's just one example, I mean, wages have kind of held in there, that, inflation can come down, or is there just such a positive correlation between wage growth and inflation that inflation can't, it's like fighting against
Yeah.
like the tsunami?
Well, so I don't like looking at any single indicator as the like sort of singular driving force of inflation. So I think this is one thing that where a lot of especially professional economists get sort of tripped up on this stuff is, for instance, the Phillips curve is something that's very popular in economics, where we look at basically the level of employment relative to inflation, and the theory goes that these two things are sort of inversely correlated, that as unemployment rises, you should get slack in the economy, lower demand, and you should get lower prices, and vice versa. And it's a similar sort of theory with wages. The story, I think, is always more complex than that. So the data on this doesn't, when you actually do a proper comparison of it, it doesn't look as tight of a correlation as some of the, especially the old school Phillips curve data made it look like back in especially the 70s and 80s. And the reason for that is that there's just lots of things that cause inflation. So you can get, for instance, during COVID, like a lot of people love trying to peg this to like one thing. They said, oh, it was all fiscal spending, or, it was all corporate greed, or you can pull up all sorts of political narratives that people from various political parties would pin this down to. And the reality, I think, is that there were lots and lots of elements that caused the inflation that we experienced during COVID. And this is just generally always true. I think it was part government spending, it was part supply chain, lots of other factors that played into this. And so, I think a lot of labor theories of inflation try to look at the labor market and then wages, and they try to then draw a singular causation to inflation. And it's never that simple. So wages, I think, are useful to understand, I think, in the context of what an economist would call sticky inflation, meaning that like sticky price theory. When you think of like the way that our earnings work generally, wages tend to be sticky in the sense that we don't often see wages actually go down during a recession. And that's in large part because behaviorally, people just don't allow it. You won't stay with a job that, cut your wage by 20% when, you go into a recession or something like that. So there's this weird sort of behavioral stickiness in the way that inflation works, where wages can create sort of I think a floor in inflation over the long term, but they're not necessarily like the singular driving factor in inflation. So as inflation rises, you tend to get sort of a lagging effect where inflation rises, wages rise subsequently, and that creates sort of a new floor under the price level. But it's not the driving force necessarily of what actually caused the inflation.
I'm wondering, one of the things that surprised me that I've been wrong about the whole time here is as the Fed has hiked rates, I really expected the economy to weaken. I expected like the labor market to weaken. And it seems like all of that has stayed a lot stronger than maybe not just me, people who don't know a lot, but also like professional economists. Why do you think that is? Why do you think everything has stayed so strong despite the big rate hikes?
Yeah, it's sort of sector specific to a large degree. Like the housing market has been really weak. Pricing hasn't been weak necessarily, but well, I guess that depends on where you look. If you're in commercial real estate, it's been pretty bad. I think prices are down 15% or so. Residential's been really strong though. And that's, in large part, I think because the the demand came way down, but the supply was just never there to actually like create like a big shock in negative pricing. And so, it is pretty sector specific, but I think the big driving factor in a lot of this is that fiscal policy, especially last year, was a lot bigger than a lot of economists expected it to be. And I think that is actually, I think, the big lesson coming out of not only the GFC, but also COVID is that fiscal policy, government spending and government deficits can cause big inflation if we spend a lot in excess of what we tax. And I think the deficit last year was much larger than a lot of economists expected. And that, continued to sort of flood the system a little bit with more and more, call it money printing or financial asset printing, whatever you want to. And that has put, I think, a floor under the economy to some degree that stimulated growth. But you also get a weird factor in the way that consumers respond to rate hikes, in the sense that rate hikes can put a lot of pressure on corporations, and they're putting a lot of pressure, for instance, right now on commercial real estate. But consumers, the way that they tend to respond to, for instance, rate hikes during a high inflation is they borrow more. And so a lot of what's been happening in the last 12 months is consumers have been borrowing a lot more to make up for the inflation they're experiencing. And a lot of the question going forward is, how sustainable is that? And, I don't think it's like a disaster in the making, but I do think that at some point in the next 12 to 18 months, you're going to get sort of a little bit of a give back in personal consumption where, maybe we don't get a recession necessarily, but, I've been sort of in the camp of like a sort of a muddle through, like 1% to 2% inflation for the last year, which, has been, obviously the economy's been stronger than that. So, I haven't been really bearish, but the economy's been stronger than I expected it to be. But I do think that we're returning to trend. And, the question is now, do we moderate into that in this sort of like soft landing scenario? Or do we, does the economy potentially overshoot in the wrong direction, where the Fed stays really tight and consumers end up not borrowing a lot and, tightening their own belts a little bit here, to the point where you get a little bit of a give back from last year?
Digging into the labor market a little bit, you had some really good tweets recently with some charts that I thought were really interesting. And, the first one is, and we'll put these up on the screen. The first one is you contrasted full-time employed with total payrolls. And it's interesting, like full-time employed went up for a period of time and now has shown a decline, whereas payrolls have been pretty consistently going up. So can you just talk about what you're showing there?
Yeah. So this is another thing that I think is consistent with the way that consumers are experiencing inflation. It's interesting because if you looked at just the headline payrolls data, it looks very positive. But when you actually look at the way that we're getting the growth of that payroll growth, you're actually seeing that a lot of it is coming from people getting second jobs. And so that's if you look at the full-time employed chart, it'll show something that looks a lot more sort of stagnant. It's not going down like you would see in, say, like a big recession or anything. But a lot of this is that people are making up for the inflation in unusual ways. They're either borrowing a lot more or they're going out and getting a second job. And the good news in all of this, I guess, is that A, the credit is available to actually borrow, and B, the second jobs are actually there for people to, fulfill. So, again, that's not a lot of people. Like if you look at like Zero Hedge, you'd probably see this as like some sort of like doom and gloom scenario. And the truth is probably somewhere more in the middle there, where it's like, it's not great that everybody or a lot of people are being forced to go out and get second jobs, but it's also true that people are able to go out and get those second jobs right now. So until you sort of see that, the flip side of that, where those jobs aren't available, or worse, they're getting eliminated, you're gonna see, I think, sort of a middle ground there where things are soft, but there's that risk. And this is the risk that the Fed is confronted with right now, and why they're starting to talk about rate cuts, I think, is that the risk, I think, in their view now is to the downside on the economy, where if they stay too tight for too long, you could actually see a scenario where things, kind of overshoot to the downside. And that's that's evident in things like when you look at like the chart of the quit rate. That's a really good indication, and that's basically the number of people who are quitting on a monthly basis, and that's indicative of really, I think, how much negotiating power the workers actually have relative to like capital. So, like, can you actually change jobs because you want to, because you just want to quit and go get a different job? Or, when the quit rate declines like it is now, that's typically indicative of an economy where workers are losing their negotiating power and they're kind of a little bit more back on their heels. So again, it's not at a level, we're kind of just back at like pre-COVID levels, which, the economy pre-COVID was just fine. So we're kind of back in that scenario, but the trajectory that we're on right now is not really great for the future of the potential growth of the labor market.
You referenced the Fed, and they seem to be in a really challenging situation right now. On one hand, like I referenced, the economic data stayed strong. Although, like you said, there's some signs of weakness that are coming out. Inflation's come down. I mean, I don't know exactly, given all the measures we talked about before, what it actually is probably hard to figure out. But it's certainly coming down in the right direction. How do you think they're thinking through what they have to do right now? The market seems to expect a lot of cuts this year. That seems to be getting pushed out in the future here a little bit as we get stronger data. Like, how do you think they're thinking through where they are right now?
Yeah, I always say this, but being on the FOMC or the Fed board it's got to be one of the worst jobs in the world. Just because there's no way that you can please everybody. And I think the biggest problem with the way that the Fed has to operate is that they have to be able to, they can't really operate like the way we do, where we're able to make sort of guesswork and, assume what's going to happen with either the market or, our interest rates. And we can do that based on projections and modeling of like theoretical data or whatever. The Fed can't really do that. The Fed has to go before Congress and be able to say, look, we did this because this data at this time proved this. So for instance, in like 2021, I remember, I'm sure you guys remember when all the crazy stuff was going on in the markets and there were, just crazy stories about either like people selling fart jars for $250,000 or all the stuff that was going on in crypto. I remember back then just watching the housing market and how crazy things were in the housing market, seeing people lined up for open houses with like, 100 or 200 people trying to buy one house that was already overpriced. And there were all these pricing indicators in 2021 that made it, at least in my mind, it looked like the risk of inflation flaring up on the upside was relatively high. And the Fed didn't have the luxury of being able to just like make that assumption that this was a big risk. They had to be able to wait and see. And so 2022 rolls around and then the hard data starts to really, come into CPI and PCE. And then they start raising rates. And that's the way that the Fed has always operated. And that's because by design, they have to be very data dependent because they have to be able to justify everything they do. And so it's sort of an inherent flaw in the way that the Fed has to operate, that they end up many times or most of the time lagging in the way that they operate. And like I would say, gosh, I mean, I said inflation peaked like a year ago, and that the Fed wasn't going to do anything because that wouldn't actually bleed into the data for, a year or two maybe. And we're seeing that now that it's bleeding into the data, but there's a real chance here that the Fed is still lagging in a way that creates, a material risk of them being too tight for too long. It looks really good so far. So the Fed has, this is sort of almost a weird environment in the sense that the Fed looks like they've handled this really, really well so far. So kudos to them. But their MO tends to be they wait until the data is already baked in. And by the time the data is already baked in, it's kind of too late for the real economy, in the sense that like something either bad or something unexpected is happening.
And that's why you kind of hear like with these rate hiking cycles, it typically ends with something bad going on and like significant rate cuts, right? I mean, they typically are not trying to like do 25 basis points at a time to like ease the economy down. Usually something goes very wrong, right? In terms of these cycles.
Yeah, I mean, that's sort of you don't always, I think that's one of the things that maybe explains a lot of the excessive pessimism of the last few years, is that a lot of people are looking at like the financial crisis and saying like, oh, the Fed over tightened then and then caused a big credit crisis. And now home prices are going to crash. And, I mean, the GFC was so unusual that I think that comparing this environment to the GFC is not really apples to apples. Um, but at the same time, like you're in an environment where, let's say that, growth is 1 to 2% by middle of the year and the unemployment rate starts to tick up, the Fed's going to find themselves in a situation where they're going to feel like they have to start cutting, not because they want to, but because they kind of need to start sort of getting ahead of where, the economy might be going. And that's, again, that's just kind of their MO, the way that they have to operate by design. So yeah, I don't think they like that's the way that things work, but it just, the job function is just one where they have to be able to, fully be able to prove why they're doing the things they're doing.
Well, and we'll see if it's different this time, but it does seem like they're going to attempt, more of the soft, 25 basis points at a time this time. It seems like that by the middle of the year, they probably will start doing it. And, the question is, I guess, can they get it down enough before things break that this is different than some of the past ones?
Yeah, it'll be, I don't think that we're at like a risk of like a GFC type of event, but there's a real material risk that like the unemployment rate could spike to like 5, 6%. And I think in that sort of a scenario, I think a lot of people would look at what the Fed has done and they'd say, you were too late raising inflation, and then you waited so long to cut rates that you ended up, causing more unemployment than was necessary. And now, 1 million people are out of work for no good reason. Um, and frankly, I mean, like there's so much guesswork involved in like the way that they tinker with interest rates that, I mean, it's virtually impossible for them to always get it right. Like I'm a big advocate of automating the overnight interest rate, basically taking human beings out of the equation. And, so something sort of like, if people are familiar with like a Taylor rule or something like that, or some sort of automated rule. I mean, I'm just in general, when it comes to like portfolio management and economics, things that you can automate, I think should always be automated, in the sense that remove human behavior out of this equation as much as possible, because we inherently are reactive and bad at predicting things in a way where, to the sense that you can automate anything, I think improves the stability of the way these things work, so that you don't get, environments like 2022 where the Fed, rather than, incrementally raising rates in a sort of nice systematic manner, like the way you're talking about, or cutting rates in a nice systematic manner. Back then they were raising rates by, 75 basis points at a time, which is, that sort of like hyper reactive response causes problems. And people say, oh, well, the last few years have been all hunky dory, but, that's not true for like regional banks or commercial real estate, or a lot of like specific sectors where you've had real turmoil, and that turmoil is largely a direct function of what the Fed was doing and the way that they were sort of, herky jerky with the way they've been driving the car to some degree.
Do you think there's anything to this idea that they like, or that they get political pressure, like especially in an election year? Like, it's interesting. I was listening to Powell in 60 Minutes, and he was basically like, our integrity is our number one thing, and that doesn't influence at all. But then you listen to all these macro podcasts, and like every guy is always saying that. They're like, the Fed doesn't want to cut, but they're going to cut because it's an election year. They're getting pressure from politicians. They're getting pressure from Wall Street. Like, do you think that pressure gets through to them?
I think in general, as far as like government institutions, I think the US Fed is about as truly independent as it gets. So like, I think Powell has been really independent. I mean, Powell was really, I mean, in a bad way, pressured by Trump, back when Trump was president. And Powell really, like, he stuck to his guns for the most part there. So, and I think the one thing that we're going to see this year is, and this is part of the rate cut narrative this year that I think maybe some people haven't looked into, is that they're very unlikely. So there's a meeting in, I think, September. They're very unlikely to do anything in September just because it's too close to the election. They don't want to appear political. And so you might, if we get rate cuts, you might get one in July. I think there's another meeting there's a meeting in June, and I think there's another one in July. My baseline right now is we'll get a rate cut in June. And then I wouldn't be shocked if the Fed sort of sits tight, rides it out through the election, and just doesn't do anything because they want to appear, totally apolitical. And then maybe in October, November, end of the year, you get a couple more rate cuts when the dust is sort of settled after the election. And, Donald Trump becomes the king of the United States again.
Well, it's interesting too on Trump. Like we were doing another podcast the other day, and like the person we were talking to was like, basically, if Trump wins, Powell's gone anyway. Because I don't think Trump is a fan of him. So like it might be like in whatever January he's out of here anyway.
Yeah, that actually would be. I can't remember who. I think maybe it was Josh Brown who was talking about that the theory that that Powell might actually resign before the presidential election. I don't know. I don't have a strong opinion on that. I mean, I think Powell weirdly seems to really enjoy being Fed chief, or at least he's very, very good at it as far as Fed chiefs go. I think Powell is very neutral. He hasn't been persuaded much by either political party. And I think as far as this stuff goes, like I was watching an interview with him the other day after the rate decision, and he's talking about things in a very practical manner where he thinks inflation is coming down, but he's still trying to be, data dependent to some degree, but also like managing the risks to the economy to some degree. So, there was a little bit of that sort of risk management thought process that an asset manager would implement that you don't hear that from Fed chiefs very often. And so I think Powell's been a great Fed chief for the most part. It's so easy to beat up on them because the job is an impossible one based on utilizing tools that are deficient, that, tinkering with interest rates and quantitative easing are extremely blunt instruments that are imprecise at best. And so, we think of this guy as like the driver of the vehicle, but really he's almost like a guy sitting in like the passenger seat with like his hand on the stick shift, and like he's influencing the vehicle to a large degree, but he's not the one that is hitting the gas and the brakes on the economy all the time. And I think a lot of people think of them as, these sort of like the driver of the economy to some degree, or these money printing gods. And the reality is that it's so much more complex than that.
Yeah, it's interesting. If they pull this off, I mean, he has to be considered one of the better Fed chairs, right? I mean,
Oh, for sure. Yeah. Especially coming out of COVID. Like I would argue that the COVID environment has been arguably, I mean, with the exception of like the 1970s, which must have just been impossible for any Fed chief to navigate. The recent COVID experience has been so crazy. I mean, nobody got all this stuff like 100% correct. It's been such a crazy ride over the last like 3 to 4 years that, I mean, the fact that they're in the position they're in right now, I mean, is sort of incredible.
I wanted to ask you about this thing I don't understand very well, which is this neutral rate of interest idea. And so the idea, I guess, is that there's a rate where the Fed is not being restrictive, but they're not being loose either. But it seems like that's also a pretty nebulous concept. It doesn't seem like they necessarily know what that is. So I'm just thinking, like, how do they think about that? Whether they're being tight or whether they're being loose relative to this neutral interest rate?
Yeah, gosh, I mean, so the neutral rate of interest is sort of in economic terms, it's like the equilibrium rate. It's like you could think of it as like the interest rate that doesn't cause like a lot of inflation, but also isn't causing, unnecessary unemployment. So it's sort of like it's like the perfect rate for the economy. And I've always, as a theoretical sort of concept, it's interesting, but the idea that someone could actually quantify that number and then that the Fed could actually impact the economy in a way through that interest rate, I've never really found that to be super useful. So like imagine it's almost like a Wall Street analyst who has like a theoretical neutral valuation, and the valuation of stocks and bonds that this analyst theorizes is like the perfect rate where stocks are neither overvalued or undervalued and could sustainably just grow at this rate in perpetuity. And we all kind of know, like, nobody knows that number. It's just, you can make up models and theories about it and quantify it and, tell everybody that this is your neutral valuation for the S&P 500. And the market just doesn't give a crap about, what your theoretical model is. More importantly, for the Fed, I think the bigger problem is that even if you can quantify what the neutral interest rate is, if the Fed tries to actually fine tune the economy using interest rates, well, it ends up being sort of a blunt instrument because the overnight interest rate, for instance, doesn't have a direct impact on everything. Like, it has a sort of an indirect impact on things. So when the Fed goes from 0% to, say, 5%, like they did in the last few years, mortgage rates don't necessarily go from, exactly in a proportional manner. For instance, credit card rates don't go in a proportional manner relative to what those interest rates do. And so there's the weird thing with interest rates, especially, and the way that all credit is structured in the economy, is that there's like thousands of different interest rates across the economy. And the idea that one interest rate impacts all of these interest rates equally or immediately is just not true. And so, not only is the theoretical idea of a neutral rate of interest probably impossible to quantify, but the mechanism by which the Fed actually tries to then impact everything through that is probably a blunt instrument at best. And, we're seeing that now where, a lot of people, probably expected that raising interest rates from 0 to 5% would crash the housing market. And, you'd get a 20-30% decline in housing prices because, purchases have dried up and, new mortgage activity has completely dried up. And the reality is that the impact of the interest rate was much more complex, in part because there's a lot of other stuff that impacts pricing in the economy. Like in the housing market, you killed demand through, raising interest rates, but you didn't really impact the supply side of the equation all that much.
Just go back to the election for a second. There was an article just today in Bloomberg. It caught my eye earlier this morning, and the title was "Investing for Trump 2.0 is trickier than you think." And it was this guy by John Authors, and he's a good writer. And so the point he was making with a Trump victory, I'm just interested in what you think here. Like, he was saying that in the case of a Trump win, you get populism that comes back, but that also Trump will want to spend money. And so I wonder if, and we know that Trump, probably would replace Powell, or Powell, like you said, might even resign or something like that. So it's almost like maybe like the hidden risk here in a Trump victory that no one's talking about, or maybe that I'm just maybe people are talking about it, I just don't know, is that Trump wins, and because of some of these policy decisions, inflation, which is kind of like getting under control to some extent, there's a risk that pops back up, and it kind of undoes what a lot of the progress that the Fed made. And if that were to happen, then, that could be kind of bad for the markets, I think.
Yeah, that's an interesting scenario that, if Trump were to win and let's say they were able to get, more control over Congress,
Mhm.
and you got a replacement of the Fed chief to somebody who was much more sympathetic to Trump or whatever. Yeah, I think inflation could definitely flare up in the next like 2 to 3 years, because you'd get probably, more spending. So fiscal policy, I think, again, fiscal policy in my view is that's where the real money printing occurs. And if you got a Fed chief that was really sympathetic to that, you not only could get a lot of fiscal spending from the government on average, but you could get much easier credit in the interest rate markets, where you'd get a big comeback, especially in shelter, because the demand would surge again. And we all, that's another big lesson from COVID, is that shelter inflation plays a big role in overall inflation, even though it lags. And so, yeah, I mean, how realistic is that? I don't know. I mean, I do think there's a really good chance Trump wins. You know, I think the one I think other lesson from maybe the Trump presidency is that a lot of people, there was a lot of hyperbole about Trump's sort of, dominance over policy in general. And I think the interesting thing from his presidency is that, our system, the way it's designed with checks and balances, actually proved that it works fairly well, because there were a lot of checks on President Trump, whether it was, members of Congress or the Supreme Court or just the courts in general. The system of checks and balances, I think, proved to work in a sense where you don't really ever have a risk of like King Trump being this sort of authoritarian figure like you might have in some smaller sort of third world countries.
I just had one more before I hand it back to Justin. I just wanted to ask you about the idea that the Fed might change the way they change their target or change the way they target inflation or something like that. There's been some talk of that they might go off the 2% target, or they may target a range or something like that. And then other people say, that would be really, really disruptive. Like, they can't do that. I'm just wondering if inflation like lingered, not high, but like a little bit higher than where they want it to be, if they would try to find some way to change the way they target it to try to, allow it to be where it is.
Yeah, it's weird. Inflation targeting is sort of a new thing. I mean, so for people who don't know, the story goes that the inflation targeting came basically from, I think it was like a New Zealand central banker who in an interview talked about an inflation target of like 2 to 3% or something. And this then sort of became a thing that was more and more common in developed market central banks. And so inflation targeting is sort of a new thing. And I think the thing that is sort of weird about this concept of inflation targeting is that nobody really knows what the right rate of inflation is. Like, is 2% better than 1%? Is it better than 3%? Is it better than 0%? Like, why don't we target 0% inflation? And I think the reality is, I think economists kind of don't know. Like, what we know is that a fairly low rate of inflation tends to be consistent with a growing economy and generally improving living standards. So, but we don't really know, what is the perfect rate of inflation. So, I don't know is really the right answer to your question, because I don't know whether 3% is better than 2% or 1% or 0%. So, does it really matter whether the Fed is targeting 3% versus 2%? I guess it makes a difference for their policy overall. But in general, I think as long as we have a generally low rate of inflation, I think that's consistent with policy and economic growth in general that is good. And I think that's one of the things that I think a lot of people tend to get wrong, is that they think any inflation is bad, and more complex than that. Like we talked about earlier, inflation tends to be sticky. So you tend to get a rising overall price level in the long run, in part because you have these sort of weird quirks in the way that not only people behaviorally operate within the economy, but just the way that the economy functions in general, that you don't have like a steady deflation ever, really, because of things like sticky prices and whatnot. So some low level of inflation is not necessarily bad, and we don't really know what that right level of inflation necessarily is. And it's probably environment contingent too. Like a rate of inflation in the early 1900s for the United States, when we were like a smaller emerging market economy, a rate of inflation in like 3 to 5% was probably okay back then, because you just had a really small growing economy that was sort of booming. Whereas now the United States is more like almost like a dividend paying stock now. We're sort of just like this big behemoth that we're so big that we grow at like 2 to 3%. And if you have 1% or 2% inflation, that's fine. But on the whole, the economy grows and living standards in the long run improve, and things are okay in general, despite a low rate of inflation.
Yeah, it's interesting. Like on that point about like a little, a low level of inflation being good, they asked Powell on 60 Minutes, I remember, about like, not just is inflation going to come down, but what about if prices come down too? People would love it if prices would come down. His answer was basically like, you don't want that. He's like, when you've looked historically, when that's happening, it's never good.
Yeah, it kind of goes back to what we were saying earlier. Like, oh, you want, like, a lot of people want prices to fall by, 20 or 30% to go back to sort of the pre-COVID levels. But the question then is, somebody said this to me on Twitter, and I asked them, well, wages are up 25% over the same period. Do you want your wage to fall by 25% or more? And the person said, well, obviously no, but why can't my wage stay where it is and prices fall? And it's like, well, it's not the way things work, like, if you want prices to fall, wages are probably going to fall to accommodate that. And then, you kind of have to ask yourself, are you better or worse off in that environment than you were when your wage was higher and prices were higher?
We obviously the three of us, were kind of early in our careers during the internet sort of boom and bust. But what came out of that period was obviously many great companies and the internet and all the things that have been built off that, and that is now a huge part of our economy, productivity. It's created new businesses. It's created $1 trillion companies. And, there's this thought that AI has the potential to be, as big. I think there was a McKinsey report I read, and I don't know over what period of time, but it was something like, $4 trillion worth of economic activity or profits. And they tackled all these different industries and looked at all the different ways that AI might help improve business and make business better and more profitable. And I'm just wondering, because you kind of have this strong sort of economic foundation, when you see things and hear about things like artificial intelligence, which is all the talk and the rage now, and I do think I'm interested in your opinion, if what you think on it. But when you think about it and the influence of something that has the potential to be that big on the economy and on inflation, like, just, do you have any thoughts on that? And what are you thinking?
Well, I think in terms of the economics of it, I mean, the baseline assumption is that it increases productivity and probably is another sort of really big long-term inflation headwind, in the sense that, like, the internet put downward pressure on prices, in the sense that it made everything sort of so much more efficient to be able to obtain, that the internet in general and technology in general has been massively deflationary. Artificial intelligence is just another extension of that. So it's sort of like, I have this sort of general macro thesis that I think that we're in, especially in the United States, in older developed economies where the populations are slowing. You have a big sort of secular headwind for inflation in general that can only be offset if the government does, like, huge fiscal policy, or some sort of exogenous shock hits like COVID, where you get, like, supply chain shocks and stuff like that. But in general, I think the long-term tendency is for inflation to be a moderately low rate, similar to sort of the post-financial crisis period, or even the pre-financial crisis period to some degree, where you had 20 years of basically a moderating rate of inflation. So even though inflation is rising, it's rising at a relatively low rate. And artificial intelligence just exacerbates all of that. I mean, think about, I don't know, think about 200 years from now. Like, everyone is going to be sitting around with probably, like, a personal assistant robot. Like, I may not even be doing the financial planning or financial advisory work at a firm, because I'll have a robot that, just does all of this stuff for me. And then, is that good? Is it bad? Does it cause unemployment? I mean, I'm not in the view that technology causes unemployment, which I think is a sort of like Luddite view that a lot of people have, that they think that technology is going to displace people at such a rate that it'll cause us all to be unemployed. I think people generally, what we're doing over time is, technology allows us to sort of use our time in just other ways, where we can refocus on other things. Like, washing machines didn't, put all of the people out of work who, used washboards. Those people that used to use washboards now, they put their clothes in the laundry machine. The laundry machine does the work for them at that time, and then you can go do something else. And that's that's the basic gist of what technology and what AI is going to do. So I would assume that it increases productivity substantially, but also puts this sort of like downward pressure on inflation because it has this sort of effect of, similar to the internet, where you get this sort of downward pricing effect through sheer efficiency.
Have a feeling all the white collar workers are going to be just sitting there with their personal robot, and the plumbers are going to be making like $1,000 an hour because you can't really automate that.
Yeah, so that's one of the like really interesting things about like with the way the economy is going is that like even when you look at like this was sort of front and center during COVID, I think that people still have to live somewhere and all this stuff, no matter how many robots we have or artificial intelligence or, internet communities and whatever, everyone's still living under real assets. So you still have to move, lumber and concrete and all these things, pipes and whatever. And so in a weird sort of way, I think a lot of middle class, sort of, people that feel like they've been marginalized over the last 50 years, I think weirdly, like I would be really bullish on in the next 50 years, in large part because those people, those skills have not gone away, but I think increasingly people don't have those skills.
Mhm.
And those skills are becoming much more valuable because they're just becoming more rare because of more and more people are becoming, whatever influencers or, living on the internet or, relying on technology to make a living. And, you can't really be a technologist who's a plumber.
We're trying to build a YouTube channel like Jack and I are doing. So let me, as we wrap up here, what do you have any like base case thoughts on the next, 12 to 24 months? You can use probabilities, but where we'll be at with sort of inflation in the markets, soft landing. I mean, a lot, obviously, like we talked about, the election is going to be a big deal. It's probably going to move markets either way. But do you just, what are you thinking in terms of sort of some base case stuff right now?
Yeah, I mean, my sort of, I think, working base case over the course of the last few years has basically been that you had this big, you had the big bust initially in COVID. You had the big government response, the big supply chain shock, and everything since then, you had a big boom then, and everything since then is just sort of mean reverting. So my general view, I think if I had to like distill it into like a really, really simple understanding is that we're returning basically to like the pre-COVID environment. Everything will eventually sort of look similar to the way it did pre-COVID, except that, your beer isn't going to cost $5. It's going to cost $10, So inflation, like we've talked about, has jumped up. The price level has permanently sort of plateaued, but the rate of change across all this stuff is normalizing. And so that's happening not just with inflation, but it's happening with economic growth more broadly. Consumer consumption, I think, is continuing to sort of mean revert. And so all this stuff is going to mean revert back to more or less where it was pre-COVID in terms of like the rate of change. And that means that inflation is going to continue to probably moderate towards the Fed's target of 2% or so. I don't think it's not going to happen as fast as the Fed probably would like, but we're going to get there probably by certainly, I think, early 2025, I think we'll be there. And during the course of that, the economy is more slowing down a little bit. Consumer consumption is slowing down. You're not necessarily in a recessionary environment. You're in sort of this like pre-COVID sort of like muddle through environment where growth is like 1% to 2%. Things aren't bad, but things aren't great. But with the Fed being as tight as they are, the risk of something sort of unforeseen hitting us all is higher than normal. So like the outlier scenario with all of this is that as we're sort of glide pathing into what looks like a soft landing, there's this sort of unusual risk that as the Fed is sort of dropping the plane into a smooth landing, that, they're being too restrictive and that something sort of unforeseen happens in, especially like the credit markets or something. And, I wouldn't say it's like a high probability outcome, but there is still, looking historically, every time the Fed raises rates at the trajectory that they have, and you have real interest rates as tight as they are right now, you tend to get credit markets that are just really tight. And that causes weird things, whether it's a big seizure in, consumer borrowing at some point, or the commercial real estate thing ends up flaring up, or the regional bank thing flares up again, or something like that. And so, that would be the thing that I don't think it would cause like a GFC repeat, but it would cause a recession and probably catch some people, in sort of an uncomfortable scenario where they either lose their job, or, the economy just slows enough to a point where you get the unemployment rate spiking, and the Fed is then sort of, more reactive than they'd like to be. But that is sort of like the outlier scenario. My base case is basically that inflation is going to moderate, growth is going to moderate. Do you call it a soft landing? I never liked the landing, analogy, just because like the economy doesn't land. It's just, so it never really made sense to me that like, we're not putting the plane down. The economy doesn't stop and then pull up to the gate and everybody gets off, like that's just not how it works. The economy is something that basically is always flying. And I think the way to think about this that's kind of, useful for me at least, is that the Fed was flying the plane. They were flying it too fast in 2021. They had to lift the nose, raise interest rates, so that brought the plane down. We're trying to like kind of like navigate through this turbulence now, and the turbulence has moderated, but it's still, it's still with us. And the Fed is trying to figure out a way to basically get us back to like 30,000 feet, without crashing the airplane. And so that's what they really want to do. They want to get us back to a more sustainable interest rate, which is probably something in like the 3 to 4% range, where the economy can continue to grow and grow at like a sustainable rate without a lot of inflation or recession risk.
Do you think, just on that point about rates, I mean, do you think we settle like at a higher interest rate now? I mean, we had crazy low rates. You talked about like inflation and economic growth coming back to like 2019, but the one thing that was kind of an outlier there was rates were so low. I mean, do you think we settle like at a natural rate that's higher than where we were then?
Yeah, I mean, I think, especially with the benefit of hindsight, I think it's easy to say like 0% probably wasn't a great idea for 10 years. And then, but at the same time, I think that 5%, 5% overnight interest rates has created, especially in the housing market, it just really like an unsustainable situation where you're not increasing the demand with that interest rate, and you're not increasing the supply with that interest rate, which is almost like it's made the housing market so dysfunctional that, that's such a big part of the economy in general, that it's indicative of an unsustainable interest rate. I think that they really, I think, probably want to be closer to something like 3 to 4% overnight, where you have a marginally positive real interest rate, but also an environment where mortgage rates are not punitive to the point where, I mean, God, like, I personally, like, I would probably move if interest rates were 2% or 3% lower, or at least I would consider it. And it's sort of, I think, like, ridiculous that like interest rates are where they're at, where like people like me, I wouldn't even think about it, because the relative comp compared to like my current mortgage rate, it's so ridiculous that it would be like financially negligent for me to move or sell my home right now and move. So it's a situation where I think that the Fed knows that, and they know 40 to 50, 60 million people have been priced out of the housing market, at the cost of basically trying to beat this inflation fight. And I think once they beat the inflation fight, and they sort of know that it's been defeated and that inflation's back to like 2%, they want to ease things back and bring things more to like an equilibrium where they can bring housing demand back and allow people to, especially a lot of these young people who I think probably feel, really marginalized from the huge run up in house prices and the cost of a mortgage now. They want to bring those people back into the market where they can, then just, people want to just be able to buy a house and live in it. They don't necessarily want to speculate, but a lot of people feel, I think, marginalized now because the interest rate structure is so punitive that they have no option but to just continue getting whiplashed by rising rents or just not being able to own a home that they want to own and raise a family and just live a life.
Absolutely. Cullen, we really appreciate you coming on, sharing all this economic knowledge with us. And you've always been kind with your time. And so really appreciate it. If people want to learn more about disciplined funds and what you're up to, where can they go?
Yeah, so the best place probably is we operate like a corporate blog, I guess it is, on disciplinedfunds.com. It's under the tab called Discipline Alerts. So we talk about a lot of stuff. I talk about, some mundane economics, a lot of like, portfolio management concepts and just life and money in general. Cause, at the end of the day, like none of us care about this stuff because money is fun and interesting so much. We care about it because, we want to be able to live our lives and navigate the future and take care of our family and loved ones and stuff like that. So, it's not all about the money. It's really about, money being sort of a means to an end. And so I try to sort of internalize that to some degree.
Good stuff. Thank you very much, Cullen. Appreciate it.
Thank you guys.
This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at @JJCarbonell. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
Justin Carbonell and Jack Forehand are principals at Validia Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital.